What happens when your long-term care policy that you've had for years gets priced higher without your consent? What if you get a letter that says, hey, guess what? Your rates are going up. We did a show on this years ago, and today we're revisiting it again. Let me bring in my co-host, Tony Short. Tony, I want to share with you a real-life scenario here, a true story, but a client who just gave me the letter he got from his long-term care insurance policy that he's owned for a number of years. In fact, he owned it before he became my client. So I inherited this policy with him, and he's been my client since, I think, 2014.
Oh,
So
wow.
10
So
10
a
years.
long time.
Right. So he's had this policy for a while.
Yeah,
And
because
we've
they're hard
talked
to
with-
get now. I mean,
Right.
most companies don't even offer a full long-term care insurance policy because it's so
Yes.
expensive. Yeah.
It's straight up long-term care. It's use it or lose it type. And it is,
So you never
a-
get your premiums back unless you go into long-term care, right?
unless you use it, right? Or there's no death benefit, right? Or unless you get involved in a class action lawsuit, which is what's going on here. So let me read you.
Interesting.
I'm going to read you some quotes from this letter, starting with dear insured. Quote, your long-term care insurance policy is part of a class action settlement. As a result, we are making special settlement options available to you. So we're going to go through what those special settlement options are in real time with me, Tony. Quote, you are not required to choose any of these options, and you may instead keep your policy as is. Oh, good. I can keep my policy as is. Well, just you wait for this. So the
I was going
company,
to say, then what's the deal if you can just keep the policy as is?
I'll show you what keeping the policy as is will look like. Basically, the company's offering 6 new options, and we're going to discuss, well, what should this client do?
Sure.
And obviously, if you're listening and watching this, you're interested in long-term care insurance. You may have gotten this letter yourself, or you may have your own insurance policy and saying, when am I going to get my letter? And what do I do if I get it? So we'll go through that. But here's a bit more information before we get into the actual offers, because this is buried a little bit further down, but I bring it out because, man, it's interesting. All right, quote. As you evaluate these choices, please be aware that as of 3/8/2024, we plan to seek cumulative rate increases of approximately 189% on policies with lifetime benefits and inflation benefits. Now, this particular client has a lifetime benefit and an inflation benefit.
Sure.
Lifetime benefit meaning that as long as he's alive, they're going to continue to pay him out on this policy for long-term care.
So-
Additionally, the benefit is increased with a 5% inflation built in. So we'll get to what that looks like in a moment.
So he's just looking at no big deal. This is not really a big deal because he's just looking at a rate increase of 189%.
Well, that is what the company, that is what the
shnikes.
company is asking for. That's not necessarily what they'll get, because the state regulators have a say in this. But here's another point on that, Tony. Quote, it is possible the actual rate increases we seek will be larger or more numerous than currently planned.
Right.
So, not
So
only
if
are
they
we-
say you can't raise it 200% all at one time, they're like, okay, we'll do 100% raise this year, 100% raise next year, 100% raise the year after that. So in the next 3 years, your rates will go up 300%. Is what they're implying. It's
yeah, and I think the show we did on this,
Wow.
maybe you and I did the show maybe 4 years ago. I can't remember. It was a
Crazy.
98.6% increase. I remember saying, "Wow, that's the body temperature." It was ridiculous.
Right.
Okay, it's still
98.7.
more. Yeah, but wait, there's more, Tony.
Oh no.
Another quote. And this is directly from the letter, right? It's quote, AM Best, and for the listeners out there, AM Best is a rating company. Okay.
Yep.
They rate insurance carriers' strength and ability. Okay. Quote, AM Best currently rates, I'm going to not name the company X, strength as C++, indicating AM Best's view that Company X has a, quote, marginal ability to meet its ongoing insurance obligations.
So not only are they going to want to raise your rates close to 200% increase, which is you can't even say it with a straight face. You can't seriously just send out a letter. Here's what we're looking at. Not only are they going to raise it, they won't be able to afford to pay you out probably, because that's a really
If
bad
people,
rating. I mean, you
right,
don't
if
want to
you
go with a
don't,
company that. Yeah, you got to have an A or a B rating typically. You don't go with anything lower than that, right? I mean,
this
that's
company was an
crazy.
A+. I believe this company was an A+ when purchased. So,
That's
yeah,
crazy.
so yeah, not only are we raising the rates, if we don't get what we want, we probably will go under, is what this says.
Or it's just implying that they won't be able to meet
Payout.
the payout
They won't be able to
obligations.
pay
That's what
out, right?
and AM Best is the insurance rating, entity
Right.
in the United States. So and they look at everything objectively. They're not related to the insurance company. They're an outside source that rates all insurance companies. And if they say they only have a marginal ability to meet their ongoing obligations, that's not good.
I'll tell you what, it's something to think about, right? So if he
Oh,
does nothing, he's with this, right? That's where he's at.
right.
So, um, a little bit more background on it. Well, let's go through his options first.
Yeah, I want to hear the
Okay. So
options.
there's 6 options, and I'm going to share my screen.
So one option is to keep where it's keep the
No,
policy.
there's 7 options then. He could
Yeah,
keep it, right? So can you see the screen? Your current
yeah,
benefits, right?
I can.
So on the left column, we have your current benefits. He gets no cash payment right now. By the way, the cash payment's the settlement that they're willing to pay you to, like, hush money. Um,
Yeah.
his monthly benefit is nearly $12,000 a month, which is not bad. $12,000 a month. When he got this policy, it was $4,500 a month. The
Yeah. Well, if he
inflation
ever needed memory care, it can be as much as $12,000.
easily, right? If you get a private nursing home in the Tampa area, it's at least 100,000 a year for a
Yeah,
private room, not shared.
sure.
So his is right now about 12,000, which is on par with a quality facility. Once you add in his Social Security and other income, he should have enough to pay for anything that he likes. Inflation benefit, and this is where he's gotten into trouble, is 5% a year. Now, he didn't get into trouble. The company got in trouble. He originally bought this policy at $4,500 a month benefit, and it's now worth $12,000 by simple 5% inflation benefit. So, hey, kids at home listening, put money aside now. 5% compounding can grow really quick. His elimination period is 90 days. So that means he has to be in a facility for 90 days
Yeah.
before it'll kick in, which
That's
is 3
typical.
months. So that doesn't change. In any of these offers, they're not changing the 90-day elimination period. The benefit period for him is unlimited. So he'll get $12,000 a month as long as he's in need of it, which could happen for a long time, like you said, if you're in memory care, right? The total lifetime benefit is unlimited. So there's no cap on how long this will pay out. So you see how lucrative this could be for him, or how financial painful this could be for the insurance company if he begins to need it and needs continuous care for a long time. Look at his semi-annual premium, Tony.
Oh,
Almost $6,000 every 6 months. So that means he's paying
12,000
$12,000.
a year. 12 grand
Yes.
a year for this policy. That's what he's currently paying, right?
Currently.
So they
So
want to increase that. Where's the calculator? I don't have
I got my
a
calculator right
what
here.
a hundred
769
uh
times 189% is going to be almost 11 grand a month every 6 months. So we're looking at 22,000 a year.
it's going to go from 12,000 to 22,000, and that 22,000 sounds like that's the lowest possible number. It could be more. Remember, they said it could be more. Could be more.
No,
Or
I think
or
it's even more than that.
incremental raises over time.
It's crazy. regardless, I think 6,000 every 6 months is crazy.
Oh yeah, I saw that and I'm like, who can afford that? That's expensive.
Right.
Plus,
Right.
you don't get those premiums back. And if you never need it, if you never use the policy,
Yeah.
because
So
this isn't like a fixed index annuity where he's guaranteed that monthly income in retirement or at some point. He's not guaranteed
well,
anything
there are
unless
some
he goes into
long-term care, right? He's only going to get this benefit if he goes into long-term care facility
and needs it.
and needs it, not home health care. 0 days in home health care. 90%, $90 facility. So he is hopefully never going to use this, right? But between now and then, he's got to decide: do I keep this policy?
Okay. What are
Right.
the other options?
So option one is, hey, keep your monthly benefit at 12,000. That's it. No more cost of living increase. So you're capped out at 12K, and we'll pay you out if you need it, but only up to $196,000. So that's like 16 months. We'll pay you out for 16 months. And then after that, you get nothing. That represents 1.5 times what he paid into it. So he paid into this already $120,000. He put $120,000 into this, which, by the way, is option number two. We will lock your benefit at 12,000 again, but same as the first option, but we're going to max out your lifetime benefit to 120, which is equal to what you put in. So we'll give you your money back if you need it, but after that, you got nothing. And by the way, we'll give you $10,000 right now just to do that. We'll give you $10,000 cash payment up front, and then no more. You don't pay for this
option
anymore.
one and option two, you don't pay anything more in.
Correct. You're done paying.
Wow. Okay. So there's
Right?
no
So now,
premium. Yeah.
right. So, initially you're like, wow, I stopped paying. I got the long-term care benefit, and hey, I can even get 10,000 if I have
Yeah.
them only pay out what I put in.
Right.
So those are the first two options. Okay. So what I want to do is go on to the next set of options. But before I do, just want to give a little more insight into this client. He is 78, I think, 77, 78.
Sure.
Okay. Was in good health, but lately he's had some health concerns about mobility and his back. He lives alone. He does not have a spouse. He does not have children. He does not have any close relatives.
Oh,
He's kind of solitary. His mother used to live with him. They lived together. She died at 102. His primary role in his 50s and 60s was taking care of
her. Yeah.
right? Because she was truly 100% couldn't do anything on her own. But he decided to live with her and take care of her and not send her to a facility. So he knows that option is not there for him. So he's strongly considering keeping this policy. And that's what we've done over the years. When we got that 98% increase, we kept it, obviously, and based on my recommendation to him because of his situation. But now it's getting to the point where the cost is becoming very difficult, not to mention this looming 189% request to increase. It's getting to a point where we need to reconsider and these options, right?
Oh, for sure. Yeah.
So let me share the remaining options, options 3 through 6. Okay. In this, again, he can keep what he has, or he's got option 3, and option 3, 4, 5, and 6 are very similar. They all give a cash payment right today. Here's $6,000 to keep quiet and walk away. That's kind of the settlement, the class action lawsuit. Here's 6,000, 3,000, or 1,200, depending on which option he picks. The monthly benefit is where we see it drop. So option 3 is we go back to his original monthly benefit of 4,500 and cap. No more cost of living increase, no more inflation benefit. But that 4,500 is unlimited for life, and he would get that guaranteed no matter how long he stayed. There's no cap on it. But it also reduces his premium from almost $6,000 to about half, $3,000. So he reduces his amount that he pays per year. He also reduces the benefit by 2/3.
But here's my problem with all of these options on this page, 3 through 6. I can see one problem right away. Your premiums are back, so you do pay premiums.
Yeah.
And I don't believe, from what we were told earlier, that there's any chance of those premiums staying what they state here. Because they noted, our rates will increase 189%. They didn't just say on options 1 and 2. They said, or your standard, your current benefits could raise. I think they implied that rates, period, could increase. So what if I'm at 20, take the 2,900 a month? That sounds like a pretty good deal because I got, unlimited benefit period or lifetime, or maybe the next one, option 4, you get a lot more. I have to pay a little more, but hey, 3,200, I can do that. Yeah,
For 6 years. They cover you for 6 years.
yeah, but are you locking in that premium for 6
No.
years? See,
No, of course not.
that's my
Yeah.
problem. If they said this is a guaranteed premium for the next 6 years, I'd probably take one of those. But the problem is that premium could go up next week or in a month to a 189% increase, right? I mean, it could double.
Right. The problem is the unknown again. How long are you going to need it? How much is pricing going to go up? What's inflation going to look like? So if we talk about it in car terms, he's got the Cadillac of long-term cares right now.
He does.
Policies, but it's unsustainable.
Yeah, it is unsustainable for the insurance company.
The insurance company made a bad deal. They made a bad underwriting decision. They should not have issued the policy as they did. They priced it wrong.
And now they're panicked because their rating is down, because they're
Right.
like, hey, AM Best told them, you've got these policies. If you start paying these out.
It's kind of like Social Security, right? Like,
right.
This is a great deal. Social Security is a great deal, but we're going to run out. So unless you make some changes, everyone's going to suffer, right? Wait till the credit rating of the United States goes down to C++.
So what's option 4? It's
C++. Isn't that from Christmas Story? C++. Okay. Option 4 is a reduction of the benefit by 1/3. So he goes down to $9,000 a month, keeps the cost of living 5% inflation. So that's pretty nice. But the benefit is limited to 6 years, and his premium is cut pretty good, down to about $6,000 a year instead of $6,000 every six months. So
but the $644,000, that's 6 years of long-term care probably covered
at $9,000 a month.
Yeah,
which plus cost of living. So that one looks really appealing, if I'm being honest, because he was comfortable paying. He's not comfortable paying $12,000 a year right now, but he's still doing it because
he should not be doing that.
He doesn't have a lot of choices.
Yeah.
But this one paying $6,500 a year, he's reduced to 6 years of coverage, but the average long-term care stay is about 3 years or less for a man. But then again, memory care and it could, and his mom lived to 102.
Mm-hmm.
He could be in a spot where he needs it for more than 6 years. And then option 5 is they reduce it to 3 years only, no cost of living. And option 6 is, again, unlimited, but the premium's pretty high.
It is.
And they reduce it. So again, though,
I don't know.
So many options, right? So many options. And I look at the cash payment now, $6,000, $3,000, $1,200. That's noise. To me, that's noise. When you're talking about paying that $6,000 every 6 months, them giving you a $6,000 upfront payment is really, what are they buying? They're buying you 6 months. So it's not something that is easy to talk about. There's a lot of things that have to go into it. Current health is a biggie. And the fact that he's not doing great makes us lean toward keeping the policy. Longevity, he's got that working against him in this case, you could
Yeah.
say.
Yeah. The good news is we're living longer. The
Right.
bad news is we're living longer.
Yeah, right. His family situation is such that he's got nobody. So
Right.
that's working against him.
Yeah, he's going to have to take one of those options. I'm just worried about the options with premiums.
Yeah.
That those premiums are going to skyrocket on him.
We kick
I
the
don't know.
can.
I'd almost
Yeah.
take the. I don't know. Yeah, I probably wouldn't do the right thing. When I looked through those at first, I'm like, take the 10 grand, no premium,
And get your
option.
money back if you need it.
Yeah.
Right. But that's basically 1 year. 1 year of coverage.
Yeah, that's
what
only
that
a year of coverage. That's the problem there. So I'm thinking maybe option 4. You liked that one, right? But
Yeah,
the
I mean, it's
problem with
tough.
that is the premium.
The premium is still there, and the premium is there with the caveat that they're going to ask for more, and they're going to get more because the insurance company doesn't want to falter, right? They don't, and I don't even think that they're price gouging here. I think they're just trying to tread water, and the government who oversees these increases and can yay or nay, they might say, yeah, you're asking 189. That's real cute. That's real cute. We'll give you a 40% increase, right? Maybe.
Yeah.
So
still 40% is outrageous.
Right. You just don't know what's going to happen.
It's just 189% is so outrageous that it's laughable. Like it's like you can't raise rates 189% on something.
No. And in his case also, what are those other options? Does he have money elsewhere to pay for it? Well, that's been going out the window to live. Does he have an income plan? Yes, with guaranteed income. He's got a solid income, but we didn't factor in needing extra income for long-term care because he had this policy. So he eliminates this policy. Now, all of a sudden, his current income plan is not really as solid as it was because we took away the long-term care portion.
Mm-hmm.
Who knows?
Depends on his situation. I mean, if he's got, if he doesn't have a lot of immediate relatives to leave the money to, like children, or a spouse, then, and I hate to say this, but do you care what, it depends on how much money he has saved up and how much he has to lose, but or will it work out? You can just do a spend down and then Medicaid will take care of his long-term care.
Right. But his point to counter that is, Dan, I've been paying for this for so many years to avoid having to go to a Medicaid facility. I want the best of the best.
Right.
And that's what I've been paying for. And
then
so
he'll have to, then if he has the money, he'll have to keep paying for long-term care insurance and do one of the paid options.
However, he might have some other resources. There is also, which is something that people forget, other funds, other resources, other plans, is the home. He owns his home outright. He's got equity in there. He's not leaving it to anybody. If he needs long-term care facility, he doesn't need his house. So he could always tap into that as well to augment that. Now, so really it's going to come down to, well, what is he feeling now?
Yeah.
Like, what's the cash crunch now? And would he rather be in a cash crunch now with protection in the future against being in a cash crunch or being in a bad facility? Or would he rather not be in a cash crunch now and then run the risk that down the road he might be in a situation that's a little dicey?
Yeah.
I lean toward being in the situation later when it's a little dicey because tomorrow's promised to no one. You don't want to die with a bunch of money in the bank. Spend it on yourself now. Live life now. Don't be stressed, because if he starts paying it, this has been a stress factor for him. We just did our show last week on the top stresses.
Stress.
And we talked about one of the stresses being health, long-term care. And this is a top stress for him, is making this payment is something he moans about every 6 months. I get the phone call. Do we have to keep this? Should we keep this? And the message is the same every 6 months, but it's suck it up, hold your nose. Now, though, we got some other options here to kind of bail on it. One thing to consider, a final consideration, is whatever you choose here. If you choose one of these settlement options, that's it. There's no going back.
Right.
So you never know.
Yeah.
It's kind of like when my dad retired.
I mean, at least there are different options. A lot of it's laughable and ridiculous.
Right.
That letter, save a copy of that letter.
Telling me about it.
Because I want proof. I want to be able to show people, hey, look.
Right. 189%. I'll tell you what, if people if people are still watching, then they probably got that same letter in front of them. You know who I'm talking about. If you want to talk about it, give me a call. If you guys are in a situation where you're thinking about buying a long-term care policy, or you have one that you're like, I don't know what to do about, this is a very complex conversation. You're not going to get the answer on YouTube. It's going to be different for everybody, but there's so many factors in here. I've been doing this long enough where I know each person's different. I can have a completely different answer for client A, client B in the same exact situation with this company. 2 different courses that we would take, and both would be correct. So you just never know. It's a tough one. So to conclude, long-term care policies were designed poorly in the past, and now the chickens are coming home to roost, and it's forcing people to make tough decisions. And acknowledging that it is a tough decision. Do not panic, but do not bury your head in the sand, because opportunity comes knocking. Sometimes you got to take it. Maybe. We'll see.
Work with a financial professional like yourself.
Yeah. Who understands not only the long-term care portion, but also the other finances that go into it.
Yeah.
What are the other resources? What are the other avenues? So you're not just pigeonholed into thinking, what am I going to do about this one policy? There's a lot more other factors in there that you have to be aware of.
Right.
Well, Tony, I didn't think we would get to the weeds on a long-term care policy, but man, it hits home. It's painful, but it's real. It's happening. Not excited about it.
Yeah.
I'll keep you posted on what happens.
Yeah. And I encourage our listeners, don't make a move without a financial professional. Give Dan a call.
Yeah. Thanks. Everyone, enjoy the rest of the day. I'll see you all next week.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Whittle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.